Guests, colleagues, members of the press, ladies and gentlemen, welcome to the virtual release of the first edition of the Financial Stability Review for 2020. The Financial Stability Review has been published twice a year since 2004. Through this publication, the South African Reserve Bank communicates its assessment of financial stability risks and mitigating policy actions to the public. Your presence at this virtual Financial Stability Forum is appreciated. The intention of the forum is to enhance the public understanding of and encourage informed debate of matters relating to financial stability. Since the publication of the previous Financial Stability Review in November 2019, conditions in the global economy and financial markets have changed dramatically in response to the emergence of the novel coronavirus. This is a truly global disruption affecting countries from all regions and income groups. South Africa, along many other emerging market economies, is experiencing a three-pronged shock with far-reaching financial stability implications. First and foremost, COVID-19 is a shock to the health sector and to the health of South African citizens. Amongst other things, this may present challenges to business continuity for financial services providers and their customers. Second, the virus and the lockdowns needed to contain it have caused a sharp decline in economic activity, with spillovers onto the financial sector. Third, there has been extreme volatility in financial markets, including a rapid reversal of capital flows into South Africa amid heightened risk aversion. The combination of these shocks is placing a significant strain on households, businesses, and financial intermediaries. On the global level, the IMF has projected an economic contraction of 3% for 2020, an outcome much worse than the global financial crisis in 2008 and 9. In fact, this projection reflects the worst global downturn since the Great Depression nearly a century ago. Similarly, South Africa is set to experience a deep recession with economic growth forecast to fall by 7% this year. Unlike in 2008, the current shock has not originated within the financial sector. This time around, financial firms globally and domestically are stronger and more resilient. In large part, this reflects a range of financial regulatory reforms that have been jointly designed and implemented by G20 countries, including South Africa, in response to the global financial crisis. Indeed, the Financial Stability Review shows that South Africa's financial sector is more resilient and is entering this extraordinary period with significant solvency and liquidity buffers in place. However, let me be clear that financial stability risks are elevated and the outlook is challenging. Just as the country has probably not seen the peak of COVID-19 infections yet, so the economic impact of the virus is also in its early stages. Much remains unclear about the nature and duration of the economic downturn we are currently experiencing, and in turn about its impact on the financial sector. The SARB has complemented the government measures that had been put in place to support the economy. The SARB, for its part, has taken steps to ensure that the financial system continues to function effectively. It appears as if these measures, along with those taken by the authorities in other parts of the world are working to contain negative feedback loops in financial markets and to support credit access to households and firms. But just as further waves of COVID-19 must be planned for and closely monitored, so we must remain vigilant for signs of financial instability and market dysfunction. During times like these, a concerted effort is required for regulators and financial firms to ensure that financial stability is safeguarded. I will now hand over to Alex Smith, who will take us through a presentation which outlines the key messages in the Financial Stability Review. At the end of the presentation, there will be an opportunity for you to pose questions to members of the panel. Alex?
Thank you very much, Governor, and good afternoon to everybody who has tuned in. Let me share my screen now and commence the presentation. Right, so before I start with the presentation, let me just make a couple of points. I'll try to be quite brief so that there's a lot of time left over for questions and for debate and discussion. And I would also like to point you to the Financial Stability Review document, which will be made available on the SARB website, where you'll find a lot more information and detail about all of the issues that I'm going to talk about in the presentation today. Okay, so the overview of the presentation is as follows. As the Governor pointed out, the domestic and global economies are facing the worst downturn in decades as a result of COVID-19. As this became apparent in February and March of this year, financial volatility surged and asset prices fell sharply, posing risks both to financial intermediaries and their clients. The SARB and other central banks have responded decisively, contributing to a stabilization in global and domestic financial conditions. However, medium-term financial stability risks remain elevated. Indeed, we are probably only in the first phase of what could be a multi-phased shock to the economy and the financial system. The good news, however, is that South Africa's financial sector regulations have been enhanced meaningfully over the past decade. And this has considerably improved the resilience of the financial sector and, importantly, provides policy space to address the current shock. And later in the presentation, I'll allude to some of the policies that have been undertaken. So the layout of the presentation, there'll be 4 parts. The first of which is to discuss the current financial stability risks. The second part will look at financial system resilience to these risks. In part 3, we'll talk about the policies that the SARB has undertaken thus far since the emergence of COVID-19. And part 4 will conclude and then open up for questions and discussion. Right, so let me point you to the risk assessment matrix that the SARB has developed to illustrate the key financial stability risks. First, before discussing the risk, let me make a couple of points about the figure that you see in front of you. On the vertical axis, the risks are ordered based on their likelihood in terms of causing a disruption to the financial system or causing financial instability. And on the horizontal axis, the time dimension of the risk is captured. So those on the left are faster burning risks, whilst those on the right are slower burning. And finally, the colors of each risk indicate whether they have increased since the last financial stability review in November or remain stable or decreased. So what's pretty clear, I think, is that we have an unusually large number of high likelihood risks, and also a large number of risks which have increased in recent months. And this really does reflect the challenging domestic and global environment that we're currently facing. The high likelihood risks include the coronavirus itself, as well as a further deterioration in domestic macroeconomic conditions that could transpire, the banking sector sovereign nexus and the risks between the banking sector and the sovereign. And then finally, the key global risk, which is that of tighter financial conditions amid conditions of elevated global debt. The other two risks include a cyber attack, a potential cyber attack on key financial infrastructure, as well as a new risk to our matrix, which is that of climate change. Let me be clear that these risks purely reflect issues related to financial stability. Of course, things like coronavirus and climate change pose risks along various dimensions, including environmental and health risks. But today we're only referring to them in the context of financial stability. In the slides that follow, I will talk to the top 4 risks on the matrix. If you'd like more information about the other risks, please do consult the Financial Stability Review. Right, so beginning with COVID-19, which is clearly top of mind and the key risk at this stage, I'd like to make a couple of key points about its impact on the domestic financial sector thus far. As I indicated, we're probably only in the first phase of the impact, but already we have started to see certain things coming through. So first, we've seen a sharp decline in economic activity, although not all economic data is available. High frequency data, including things like vehicle sales, financial transaction data, indicates that there has been a sharp decline in economic activity since March, when the lockdowns began. We're seeing in financial markets signs of dysfunction and illiquidity, including in the government and corporate bond markets. We've also seen significant asset price declines. From financial intermediaries, a number of restructured loans have already taken place. Thousands of restructured loans, as well as insurance premium holidays, have been provided to distressed clients. And finally, in the asset management industry, we have seen a preference for cash on the part of fund managers and other investors, which in turn has made it quite challenging for banks to source term funding. And the SARB has responded to a number of these issues, and I'll allude to that in a moment. Now, what we're expecting to see in the coming months is that non-performing loans held by banks and other financial intermediaries will increase substantially. We anticipate that insurance policy lapse rates will be higher over the coming months, and also that there will be increased withdrawals from investment funds, particularly because individuals are likely to lose jobs, and they may then remove some of their funds from pension and other investment funds. So now let's look at the impacts graphically on the financial sector. So these two charts just highlight some of the impacts of risk aversion. So the charts on the left is a measure of equity market volatility. The blue line, US equity market volatility, and the orange line, South African equity market volatility. And we can see that both of those measures increased substantially in March of this year to levels last seen during the global financial crisis. Very, very heightened levels of volatility being seen. Although volatility has since abated somewhat, it remains high by historical standards. The right-hand chart shows non-resident portfolio flows into the domestic bond and equity markets. And there again, we can see very, very sharp outflows from South African capital markets, with outflows in March having reached a record high level of around 90 billion rand. In April, these outflows outflows continued, but at a less severe pace. And what we can also see is that these outflows have been concentrated in the bond market, which may reflect recent credit rating downgrades of the South African government, as well as the removal of South Africa's government bonds from the World Government Bond Index. So let me now touch on the second risk in the risk assessment matrix, which is the potential for further deterioration in macroeconomic conditions. The chart that you can see in front of you shows the evolution of the SARB GDP growth forecast through time. And what we can see from this chart is that economic growth has been underperforming for a number of years in South Africa. Economic growth has consistently come in below SARB's previous forecasts. And this isn't because the bank is particularly bad at forecasting. It's been a phenomenon seen across all analyst forecasts that the economy has consistently surprised to the downside. And we believe that this largely reflects deteriorating potential growth in the economy as a result of things like electricity supply constraints, skills shortages, and policy uncertainty. And of course, now leading into the COVID shock, SARB has substantially revised the forecast lower, looking at a GDP growth decline of 7% this year. And then a recovery in 2021 and 2022, with growth just under 4% in 21 and just under 3% in 2022. However, at times like this, when GDP growth is very volatile, it's sometimes more important to look at the level of GDP rather than the growth rate. And when we look at levels, we can see that even with the growth recovery that's projected for next year and the year after, the actual level of GDP in 2022 is likely to be lower than that of 2019. In fact, even lower than that of 2018. And hence, the COVID shock could result in nearly half a decade of lost output, which of course is going to put a major strain on households and firms, and could also put pressure on banks, insurers, and other financial intermediaries in terms of both asset growth as well as profitability. Okay, the third risk in the risk assessment matrix is the banking sector sovereign nexus, which put simply is the interrelationship between banks and the government. Now, in any market economy, there are a lot of interlinkages between banks and the government, and that's very normal. However, at this stage, we are starting to see heightened financial stability risk in this interplay between banks and the government for a number of reasons. Firstly, we've seen that banks' exposure to government has increased substantially over the past decade or so. Its sovereign exposure as a share of total bank assets has roughly doubled over the past 12 years and is now at about 15% of bank assets. So government is the single biggest debtor of the banking system. And this has occurred at a time when public debt has been rising quite rapidly. The chart on the right-hand side shows the increase in public debt. What is concerning is that previous projections from National Treasury have not come to pass, and debt projections have consistently been revised upward. The red line in the chart on the right-hand side shows the IMF's projection for gross government debt going forward, based on its assessment of the impact of COVID-19. And the IMF projects that gross government debt as a share of GDP could reach as much as 85% by the end of 2021. If this forecast does transpire, gross public debt would have trebled as a share of GDP over a 12-year period, which is a very, very substantial increase. And as a result of this, we've seen a number of sovereign credit rating downgrades from major credit rating agencies. And indeed, all of the major credit rating agencies now rate the sovereign below investment grade level, with S&P 3 notches below investment grade. And this creates a spillover effect onto the banking sector, because the rating agencies have told us that they will not rate South African banks higher than the sovereign, typically, for two reasons. One, because of the large sovereign exposure that banks have. But secondly, because the South African government is also plays an important part in acting as a backstop in the event that a bank gets into trouble and potentially fails, both potentially in terms of recapitalization as well as in supporting depositors, because South Africa doesn't have a formalized deposit insurance scheme in place at present, although one is currently being developed. Hence, deteriorating creditworthiness of government does spill over onto banks, and also onto the broader financial system, because typically borrowers in capital markets face borrowing costs that are linked to that of the sovereign. So as sovereign borrowing costs rise in response to rising public debt, so do borrowing costs for a variety of other entities in the economy. And hence, we see the banking sector sovereign nexus as a threat to financial stability at present. The fourth and final financial stability risk that I'd like to touch on briefly is the key global risk, and that is the risk of tighter financial conditions amid elevated global debt. The chart on your left-hand side shows financial conditions indices for various advanced economies. Put simply, financial conditions indices provide a composite measure of the ease and costs with which credit can be accessed. A higher level for the index shows tighter financial conditions. So what we can see here is that financial conditions prior to the COVID shock in early 2020 were actually very easy in advanced economies, but then tightened quite rapidly in March and April, and have since come back somewhat, which reflects very aggressive monetary policy easing measures in advanced economies. However, the long period of very easy financing conditions has given rise to an increase in global debt. The chart on your right-hand side shows a consistent upward drift of global debt over the past few years. And in fact, global debt is now at a record high at levels that we haven't seen before. And these very high levels of global debt pose a significant risk, especially if financial conditions do tighten again, and if borrowing costs for those particularly high-risk borrowers increase. This could give rise to defaults. In particular, debt in emerging market economies has increased very strongly in recent years, and there are certain risks attached to that debt. It is encouraging that global central banks and finance ministries have responded to the recent shock and helped to ease financial conditions. But this also poses a medium-term risk if already indebted borrowers accumulate more debt based on these very easy conditions, and then they are unwound later on. This could put pressure on the borrowers over a medium-term horizon. Okay, so let me move on now from the risks to the resilience of the financial system. Now, this chart's quite busy, but what I'm trying to illustrate here is that there are two countervailing forces when we think about financial system resilience at a sort of macro level. On the downside, a key vulnerability that we're seeing right now is the weakness in the macroeconomy. So the gray bars that you can see here on the top of this chart highlight downward phases of the business cycle. Now, the business cycle, put simply, is the deviation of economic activity from its trend. So a downward phase of the business cycle just shows times when economic activity is below its sort of longer term trend. And South Africa is currently in the longest business cycle downturn on record. So the macroeconomy has been performing relatively poorly in recent years. So that's the one force that we're seeing, which kind of erodes resilience. But the other force, which is more positive, is that the financial cycle has been quite muted in recent years. Now, the financial cycle measures the deviation of various financial variables from their trend. And these variables include credit growth, equity prices, and house prices. So what the literature tells us is that when credit growth and equity growth is particularly rampant, that's when financial stability risks are most elevated. And that's when the economy is most vulnerable to a shock. But what we've seen in recent years is that credit growth, equity prices growth, and so forth have been very muted, indicating quite constrained levels of risk-taking and no clear excesses in the financial system. So South Africa enters this shock in a situation where the financial system hasn't been necessarily taking on excessive risk, which is a positive for the financial system. Moreover, as the governor alluded to earlier, financial regulation has been enhanced substantially, and a whole raft of new regulations have been brought in. I'll just highlight two key regulations with respect to the banking sector. One is that the quality and quantity of capital in the banking sector has been enhanced. Now, capital is absolutely key for resilience because it allows firms to absorb losses and to remain a going concern. So the chart on the left-hand side just shows how the minimum capital requirements for the banking sector have been enhanced. And it also shows that banks retain a comfortable surplus above the minimum capital requirements. The chart on the right-hand side indicates liquidity ratios in the banking sector. The liquidity coverage ratio, LCR, is a short-term measure of resilience to liquidity risk. And the net stable funding ratio, the orange line, is a longer-term measure of resilience to liquidity risk. Both of these measures remain above the 100% minimum regulatory requirement that was in place until recently, although the LCR has now been reduced slightly. But both of these measures indicate that banks are resilient in terms of liquidity risk as well as capital adequacy. Another point I'd like to make briefly is that there are a number of policies in place to reduce foreign currency and market risks. In a number of emerging market economies, exchange rate risk is a big issue when we think about financial stability. In South Africa, that's not so much the case. We've seen the exchange rate depreciate substantially since the COVID shock. However, what we can see is that due to limits on the unhedged foreign currency exposure of the banking sector, both the foreign currency loans as well as foreign currency funding of the banking sector are quite low, which has helped to reduce the impact of the exchange rate move on the financial sector. Right, so let me move on now to the policies that have been undertaken by the SARB since the emergence of COVID-19. The SARB has undertaken a number of policies. First, the SARB has made additional liquidity available to the banking sector through repurchase facilities, increasing both the size and duration of these facilities. Second, as I alluded to earlier, we did detect signs of dysfunction in the government bond market, and the SARB has purchased government bonds in the secondary market to address those signs of dysfunction. Third, the Prudential Authority of the SARB has reduced the liquidity coverage ratio requirement for banks from 100% to 80%. One of the boxes in the Financial Stability Review, box number 2, discusses the rationale for this at length. But to put it quite simply, the reduction in the liquidity coverage ratio will allow banks to continue to provide credit to the real economy rather than forcing banks to accumulate more government bonds or high quality liquid assets to continue to meet the 100% requirement. So this is a temporary reduction which is aimed at supporting credit flow to the real economy. Fourth, the Prudential Authority has temporarily eased certain bank capital requirements, once again, to encourage flow of credit into the real economy. Fifth, the Prudential Authority has adjusted the regulatory treatment of loans that are restructured as a result of COVID-19, which means, put simply, that banks won't have to hold additional capital against these loans. This is also aimed at allowing banks to provide temporary relief to customers that were otherwise in good standing, but are facing stress as a result of COVID-19. And we have seen banks taking advantage of this and restructuring a number of loans. Sixth, the SARB has partnered with commercial banks and National Treasury to implement a loan guarantee scheme for small and medium enterprises. And finally, the SARB has reduced the repurchase rate by 275 basis points, which supports the debt service capacity of borrowers. Of course, this is primarily a monetary policy instrument. However, it does have positive financial stability implications as well. Now, we are already starting to see that these policies are having a positive effect. The chart on the left-hand side shows bid-offer spreads for government bonds. Bid-offer spreads are simply one way of measuring the functioning and liquidity in the government bond market. We saw these spreads spike in March, indicating risk of dysfunction in the market. However, since the SARB's intervention in the market, we've seen these spreads narrow. On the right-hand side, although many factors drive South African bank share prices, we can see that bank share prices have stabilized and actually increased a little bit in recent weeks, which likely has been supported by a stabilization in market conditions as a result of some of the policies that the SARB has implemented. Okay, let me conclude before we open up for questions. So the financial sector is experiencing an extraordinary shock. There's no doubt about that. SARB policies, as well as prudent risk management by financial sector firms, has helped the sector weather the initial phase of this shock. However, medium-term financial stability risks are elevated as the duration and severity of COVID-19's impact on the economy and the financial sector still remains uncertain. The SARB is monitoring these financial stability risks closely and stands ready to implement additional policy measures as required. Governor, let me hand back to you now to take questions and comments.
Thank you very much, Alex. I now open the virtual floor for questions and comments. Please do raise your electronic hand. You click in there. If you have raised the electronic hand, we will know who you are. I now see a question from Ms. Naidu at Bloomberg. Prinesha Naidu, Bloomberg.
Yes, hi, Governor. I was just waiting to be unmuted. Thanks for taking my question. I just wanted to find out, you said that the SARB is ready to deploy a variety of additional tools. What are these tools? If you can give us some detail on that. Also, the current measures that you have implemented, about how much has that put into the economy? And also, in the Financial Stability Review document, you said that new government spend is likely to be around 3% of GDP. That's despite the 500 billion package. Is this new spend adequate to offset the impact of the virus and stimulate activity? Thank you.
Surely that couldn't have been the only question. Any other questions? Others do not know how to use the electronic hand. You can also use the chart function in the app. Okay, Maramni.
Hi, Governor. Thanks very much for doing the call today. I was wondering if you could give me a sense of what level of bad debts were envisaged under the 2018 stress test scenarios, and what level the banking sector can withstand before their capital levels start approaching regulatory requirements and they have to take action in that regard. Thank you.
Emma, I didn't hear properly the first part. You say what level of what debt?
Bad debts. So under the 2018 stress tests, what level of bad debts did they envisage? And what level does the SARB think the banking sector can withstand before their capital levels start approaching regulatory requirements and they have to take some kind of action to mitigate that?
Okay, and then there is Anthea from Prudential.
Hi, Governor. Can you hear me?
Yes, Anthea.
Yeah, good morning, and thank you very much for the session today. I just have a question that pertains to the net stable funding ratio. So we've been grappling with how steep the yield curve is currently. And I know that the SARB has mentioned before that there is no intention to impact the pricing of the bonds. You just wanted to assist with the liquidity. But our interactions with the banks have brought to light that they have been purchasing government bonds that are shorter dated, because if I understand the net stable funding ratio correctly, then the shorter dated bonds, they reflect and they count more positively with regards to the required funding the banks need. So I just wonder if that could perhaps be filtering into the pricing of the bonds and then the associated slope of the curve. Could that perhaps be an unintentional side effect of that? Thank you very much.
Let's take one more. There isn't any. Okay, Brian Khan.
Hello, Governor. Can you hear me?
Yes.
Thanks for the presentation. I'm not sure if it was covered in the previous one of the previous questions, but have we seen any increase in non-performing loans in the last few weeks, or is it still too early to tell?
Okay, thank you very much. Okay, let me take the last one, being Londiwe Buteles. Okay, it should be Lindiwe, right?
It's Londiwe.
Londiwe.
Yes, thanks, Governor. My question relates to insurers mostly, because we've heard about what the SARB has done for the banks in terms of liquidity, adjusting their liquidity to deal with this. But to what extent has the SARB looked at how much lapses insurers have to record and the number of claims or the level of claims before they get into trouble, if you've looked at that? And I just want to add to the last question about non-performing loans in the recent weeks, if the SARB has looked at that, if maybe can give us a bit of color as to whether certain banks or certain segments of the banks are seeing more of that, or if it's across the board. Thank you.
Okay, thank you very much. Let me see what I could deal with here and leave the more interesting questions to the CEO of the Prudential Authority. Much as we would answer this, we can't talk about individual institutions. We can only talk about the trends that that we see. Prinesha, your question about the deployment of the tools, I was talking about all the tools that we have deployed so far, which is using the repo rate for monetary policy, relaxing the liquidity coverage ratio, and embarking on bond purchase program and providing regulatory guidance. Those are the tools that we have utilized. We stand ready to deploy these tools. I don't know, I didn't refer to other tools I've talked about. We deployed our tools. So these are the tools that we have deployed so far. If there is any need to use any other tools like reserve requirements or any of that stuff, we would utilize them if appropriate. At the moment, the tools that we have deployed is what we deemed to be appropriate at this stage. How much of these things that we have done have fell through into the economy? We deployed these tools very rapidly, and we had to take further steps in April with respect to the repo rate, and we did that in an environment where the economy was under lockdown. So what you normally would be seeing filtering through the economy as a result of the actions taken, you wouldn't have necessarily seen immediately because the economy was under lockdown. As the government has embarked on the risk-based relaxation of the lockdown, then you will begin to see the effect of all these measures that we have taken. It's also difficult to assess at this stage, and I'm sure you have seen the notice that we have sent out with respect to the quarterly bulletin, that the June quarterly bulletin will only be released in July. Part of it has to do with the fact that certain statistics that we require from Stats SA would not be available by the time we normally publish the quarterly bulletin, and we have got to do the reconciliation between ourselves and Statistics South Africa. So it is very difficult at this stage to assess exactly what the impact would be. What we did say would be the impact is what we had known to have been when the economy is operating normally. If you are a borrower and you, of course, had debt, there is no doubt that you would have benefited from January through now, that your monthly repayments on your debt would have been at lower interest rates. And so that the benefit for the borrowers would be immediate. But how this thing gets felt through the entire economy, whatever assessment we make would be assessment based under normal circumstances when the economy is operating, not under lockdown. It's difficult to do an assessment as things stand. Do we think that government measures that have been taken are enough? That is a question best directed at government. I'm sure if you ask them whether the monetary policy measures taken are effective, they were going to refer the question back to us. I will leave the thing about the bad debt and the NPLs to Deputy Governor Naidu. That will be the questions for Emma, from Brian, and from Londiwe, including the impact on the insurance. Anthea, you said that with respect to the NSFR, and you correctly pointed out that our purchases of government bonds was not meant to try and influence price or to try and influence the yield curve. We have not targeted particular areas of the yield curve. We have actually bought our bonds across the yield curve. So to the extent that the yield curve steepens, it would not be because of the SARB's bond purchases. But you do point out that the banks themselves are buying shorter dated bonds, and that the NSFR benefits from that. That is incorrect. They might be buying the bonds. The bonds really affect the liquidity coverage ratio rather than the net stable funding ratio inventory. So the LCR is where the high quality liquid assets are held, whereas the NSFR tries to get the maturity matching of the banks to be over a longer period of time. DG Naidu, if you could come in on the NPLs and the stress test that was done in 2018 and what we are seeing now, and yeah, and then after that, Hendrik, if you have got anything you would like to add from the stress testing, it would be useful. Naidu?
Sure. Chair, can I ask them that if financial stability first deals with the stress test, then I'll come on after them.
So, Governor, I can quickly just say a few things about the stress test, and then Wafa Anvari, who's head of stress testing, is also in on the call. He can please expand. So that the 2018 stress test looked at two different scenarios, and it was conducted on the 6 largest banks. One was a V-shaped scenario with a sharp recession and a rapid recovery. And under that GDP growth, the worst outcome was basically a decline of 4.8%. The other scenario was more of an L-shaped scenario with a recession that lasted for about 3 years. And over that 3-year horizon, actually for both of the scenarios, the V and the L shape, the banks maintained adequate levels of capital without taking any mitigating actions. On average, the banking sector's capital position is currently very similar to what it was when that stress test was conducted, but it's very difficult, obviously, to compare the two scenarios at that point and the current one, as you have different assumptions, you have different starting points for the economy. But nevertheless, I think the stress test results do highlight the resilience of the sector to severe shocks.
Naidu, back to you.
Thanks, Chair. So, what level of bad debts can the banks withstand? Let me start off by saying that there will be an increase in impairments. I have no doubt that those will be significant. Those are likely to eat into the capital stack over a period of time. First, the surplus capital, and then after the regulatory capital. It's hard to give a firm number on what level of bad debts can they withstand, because there's different risk weightings attached to different types of loans. But if you think about it crudely, there's about 509 billion rands worth of capital in the banking sector. There's about 45 billion rand worth of surplus capital thereabout, and there's about 5 trillion rands worth of assets. And so, if you put it very crudely, about if 10% of the customers default, or if 10% of the loan book defaults, you could wipe out the capital of the bank. I've looked at 80-year data for South Africa. The highest performing non-performing loan ratios went as high as sort of 4 or 5% at some point in those 80 years. The 1992 economic recession, you had non-performing loans of 2 or 3%. Financial crisis, you got up to 3 or 4%. And so you would need a very, very severe economic scenario to sort of have a 10% non-performing loan ratio. But that just gives you a crude sense of what the buffers look like. On the NSFR and the steepening of the yield curve, and whether the NSFR is having an unintended consequence of getting the banks to buy short-term government bonds, the honest answer is I don't know. It's something we can look at. I'm not a markets person, But it is not my sense that the banks have bought a significant amount of additional government bonds since the COVID crisis. But again, that's something we can look at. As the governor pointed out earlier, the change in the price of bonds has affected the LCR and less so the net stable funding ratio. The net stable funding ratio has been quite stable since the start of the crisis, at just above 100%, around 104, 105. It's been pretty stable. We've not seen much deterioration in there in aggregate. You know, one Big Four bank told me that there are about 550,000 applications for loan restructures. So that's a very large number. And I guess that is a reflection of the fact that there are significant numbers of people in distress, or think that they will be in distress. You know, I don't want to crudely extrapolate either in the form of how much that would cost, but I do think that there's significant stress out there. I think that South Africa, in one sense, is blessed because we go into this crisis with a well-capitalized banking sector. We have not had excess leverage running up into the crisis. And so for the first time, I think we will not get a pro-cyclical contraction in bank lending. I think banks can continue to play the role that they play because I think that the buffers are quite large and we've got a well-capitalized and liquid banking sector. And liquidity buffers and capital buffers are designed to be dipped into during a crisis. You know, I don't have a number on non-performing loans. It's something we're tracking with the banks on a daily basis. There is not yet a significant increase in non-performing loans. So in April, you know, we had a large number of loan restructurings take place. We had a large number in May as well. We've not categorized those as non-performing. But my sense is it's too early to tell on what the size of the non-performing loans would be. I'm sure they will come. I have no doubt about that. What have you done for insurance? Insurance, the capital stack and the regulatory framework for insurance is quite similar. Is quite different from banks. So it's not the same as you can provide regulatory relief in terms of lower capital requirements. We have the solvency coverage ratio, and we are monitoring that. So we've made no change to that. We've not tampered with the parameters, but it is expected that those SCRs will drop, and we will monitor that. In some ways, we will allow insurance companies to report lower SCRs as part of the regulatory process. Short-term insurance companies have actually seen a decline in claims because of lower car accidents and less driving. And we have not yet seen an increase in claims on life insurance. There has also not yet been a significant increase in lapses. Again, it's something that we are monitoring on an almost daily basis. Chair, I think that's it from me for now.
You have got lots of guests, Kuben. Just check in the chat group. We have questions that are coming from the YouTube channel, which we are bringing through into the chat group. They are being posted here by support. So we will have to deal with those. If you chaps could look at that. There was a question from Mark Zayman about government debt to GDP ratio. On the heat map that we have in the financial stability review, we do indicate where are the areas where we are concerned with respect to the risk. And when you look at the government debt to GDP ratio, you will actually see that it is read. So it is a concern from a financial stability perspective, and hopefully the Treasury will deal with that as they present their budget. Kuben, let's connect the questions. Just check that there are a range of questions that have to do with liquidity thresholds and the banks from Russell Lamberti and from Helmo Preuss. Can we have other questions? Please, we will collect all of those and then we'll distribute them amongst ourselves. And then, Hendrik, I would like you to deal with the issue of the resolution powers and where we are with the resolution bill now. Okay. Okay, Naidu, you want to come back and deal with Lamberti's questions?
Thanks, Chair. Chair, let me start with the policy rationale. In the financial crisis, there was a significant pullback in lending by the banks, by the financial sector. The global evidence in crises is that a pullback in lending leads to a pro-cyclical decline in the economy. More people get out of work, more firms close, more suppliers are hit. And so during this crisis, our policy rationale is for banks to continue lending, or at least to slow down the pace at which they will contract lending, for credit to continue to flow, and to relieve the capital and regulatory pressure from restructured loans so that they can provide relief to their customers and consumers. Chair, it is our view that if the banks continue to lend, continue to support their customers through the crisis would be shallower and it would be, the economy will recover more quickly. There is, the financial stability report of the Bank of England makes this point quite well. There is no trade-off here. There isn't a sense of saying, let the banks preserve capital, preserve liquidity for later in the crisis or in the recovery process. Because if the banks stop lending, more firms will go under, more people will lose their jobs, there will be more defaults, and the impact on banks would be even greater. Having said that, Chair, we are very mindful of the fact that we do not want a financial crisis, and we have to protect bank balance sheets, and we have to protect the capital and liquidity in the banking system. Chair, buffers are designed to be built up in good times and designed to be run down in bad times. It is a delicate balance. We believe that we have got that balance right. We believe that we will allow banks to dip into their regulatory minima on both capital and liquidity so that they can support the economy. But of course, we will do that within reason because we do not want to damage the capacity of the banking sector to operate and to support a recovery going forward. The last thing South Africa needs is a financial crisis. So, Chair, there isn't a trade-off, and I think that this is an argument well made in both our financial stability report, but also in the Bank of England's financial stability report in how we manage a crisis. There are other aspects of macro policy that you can argue that you should keep your powder dry for later in the crisis. Banking and bank regulation is one where deployed early and potentially withdrawn early in the recovery. So you would want banks to rebuild their capital buffers and liquidity buffers when there are signs of recovery in the economy. Chair, on the 200 billion rand guarantee scheme, at this stage, we do not know how much of this is being used. Some banks are saying that the regulatory relief that we have provided allows them to do this restructuring without the guarantee scheme, while other banks have come to us and already indicated the amounts that they think they will need, and the money has already started flowing. It's a weekly drawdown process, so the scheme was launched on the 12th of May. We've only had 2 weekly drawdowns since then. for relatively modest amounts in relation to the initial 100 billion rand guarantee. But I think that will pick up in the weeks ahead, Chair.
Okay, thanks, Kuben. There are two electronic hands, Linley followed by Peter Montaldo.
Hi, Governor. Thanks very much. I just wanted to ask you, I mean, the banks raised this question of the banking sector and the sovereign nexus. Could you just talk a little bit to how you see this risk unfolding, particularly as we're seeing so much fragility in both the government's arena, but also SOEs, and we've already had defaults there. Yeah, and just for a clarity question, I mean, when you're talking around sovereign exposure by the banking sector, to what extent does this incorporate banking sector exposure to SOEs? Thanks.
Peter Montaldo.
Thank you, Governor. I wanted to ask first on the issue that's highlighted in the report about internal risk-based modelling of government bond holdings and where non-zero weights are being applied here. This seemed to possibly crowd out other investing, other lending by banks. I was wondering if the PA was planning on sending any directive or guidance to encourage IRB to do zero risk weighting on those kind of assets. And now the question on smaller banks, which the report goes into a little bit. The report highlights how there's higher capital adequacy ratios, but also much lower profitability. I was wondering if there's a particular concern about burning through that higher capital at a particularly fast rate for those smaller banks going forward, and if you've done any modeling on that. And then just finally on sort of stress tests in general, are you planning on running any new stress tests or making any stress test results available to markets to get a better sense of where strength is in the market? Thanks very much.
Thanks, Peter. Hendrik Nel, I will come back to you on the stress testing. I hope it doesn't stress you, because it looks like that's what a lot of people are interested in. Are there any other electronic hands? I do not see any. Hendrik, why don't you deal with the stress testing stuff? And then Kuben will deal with the small banks and the IRB banks and zero risk and non-zero risk weighting of the government bonds. Rashad, you have been having a good time not answering anything. Okay, I'm sure I will find something for you just now. Okay, Hendrik, you go first, and then Kuben, and then let me see if there is any other thing on the chart.
Okay, thanks, Governor. I accept you want me to deal with the resolution question.
Yes, that's well.
When asking about the SARB's resolution powers, what the powers are today, and how these would be enhanced through the Financial Sector Laws Amendment Bill. So at the moment, the Financial Sector Laws Amendment Bill containing these amendments to the Financial Sector Regulation Act, specifically to the bank's resolution powers, have not been passed. It's in bill format. It has gone to Parliament, has passed the state law advisors, and it will soon go back to Cabinet for approval to go through to Parliament. Now, currently, the powers that the bank has been implemented effectively during the resolution of African Bank in 2014-15, as well as with the resolution of VBS more recently. So although it required some changes to the Banks Act at the time, both these relatively small institutions was effectively resolved during the time, including in the case of VBS, a deposit insurance payout to all depositors up to 100,000 Rand. And this was done, although it's an implicit deposit insurance payout, it was done effectively through another bank. So these were small banks, as I've mentioned, relatively easier to resolve. And although we believe our larger banks, our SIFI banks, are safe and sound and stable, and as the stress test showed, could withstand severe shocks. In the case of a resolution of any of those SIFI banks, it would require more powers of resolution, as it's a much more complex process to resolve any of those larger banks. Those kinds of powers are provided to the SARB in the Financial Sector Laws Amendment Bill, as I said, hopefully to be passed or sent through Cabinet onto Parliament and passed fairly soon. So the powers of resolution, and the SARB is given the powers of the resolution authority, enabling it to resolve any of these larger banks and larger financial institutions. And that includes an explicit deposit insurance scheme. So I think let me leave it at that, Governor, unless Nicola, who's also on the line, wants to add anything to that.
Kuben?
Thanks, Chair. Chair, let me make one tiny addition to what Hendrik had to say. Even though the resolution is not yet law, when we resolved African Bank, we made an amendment to the Banks Act, which gave the SARB and at the time the Registrar of Banks certain powers required in the resolution in terms of the ranking and the hierarchy and the waterfall structure. So even though the resolution bill is not yet law, some of the amendments to the Banks Act to facilitate the African Bank resolution is now in place and is now part of the legal arsenal, Chair. Chair, on the sovereign bank nexus, it's largely the Basel framework in the main, in some ways, that has increased the appetite for banks to hold government bonds. And this is not a South African phenomenon, this is a global phenomenon. Banks are required to hold liquid assets, they're required to hold bonds. In a place like the US, there are corporate bonds that qualify as high quality liquid assets. In Europe, there's very little corporate bonds that qualify as high quality liquid assets. There's some DFI bonds, but not much corporate bonds. And similarly, in South Africa, there's mainly government bonds and some SOE bonds that qualify as high quality liquid assets. And therefore, the banks are obliged to hold these assets because of the Basel framework and the need to hold a certain amount of HQLA. So it is the regulatory framework in part that has increased the bank sovereign nexus. This is not risk-free in one sense, but in the context of a country, at least if banks are on a standardized approach, then government bonds are deemed risk-free. Chair, that brings me to the second issue. The big banks in South Africa are what we call modeled banks, or IRB banks, internal ratings-based approach banks, and therefore they use models. Now, it is true that in these models, they have a non-zero weight for sovereign bonds, whereas if they were on the standardized approach, they can have a zero risk weight for bonds. But in aggregate, the capital requirements for IRB banks are much lower. I'll give you an example. If I hold a mortgage on the standardized approach, I have to keep about 20% of capital. Whereas if you take 80 years of data in South Africa, the most extreme losses in the mortgage book have been about 5%. So we require our banks to hold less than the 20% in the modeled approach. They can use their own historical data to set an appropriate risk weight. And so in general, if all the South African banks were to move to a standardized approach, they would need much more capital, probably 30–40% more capital. There is a flaw in the Basel framework that limits that, and that will kick in by about 2024. But at the moment, so while banks have to hold a higher risk weighting for sovereign bonds than they would under a standardized approach, in aggregate, they hold less capital. So, of course, the banks have been lobbying us to say, can't we change the weight to zero? And our response has been, no, you need to be consistent. Either you want a modeled approach or a standardized approach. You can't pick and choose which assets you have, one approach versus the other. And the banks, in general, are more comfortable with their IRB approaches. And yes, one of the costs of running an IRB approach is that you have higher capital for sovereign risk. I guess it reflects the fact that sovereign risk is not zero. It might be low, but it's not zero. Chair, yes, second-tier banks generally do have higher capital requirements. Are they likely to burn through this? My sense is that, yes, I think all the banks are likely to report losses in the next year or two. There will be some depletion of capital. This is probably going to be larger for the small banks, but that's precisely why they have higher capital requirements and why they have larger buffers in that regard. Is this a financial stability risk? I think that if this crisis is very long and very deep, it will threaten any financial system on the planet. Our financial system is particularly well capitalized, and the buffers are sufficiently large. But we're monitoring this on a daily, weekly basis. At this stage, we don't have any concerns, Chair.
Thank you very much. Rashad? Rashad, you can speak. Is he there? Or is it me who is off?
Governor, he is there.
I can see Hendrik's microphone is on, but...
So, Chair, I can hear you, but I can't hear Rashad.
Yeah, we can't hear you.
Can you hear me now? Hello?
Yes, now we can hear you.
Yes, we can.
Okay. Let me answer a few questions. I see that there's a series of questions on the GDP. I don't want to compartmentalize the MPC meeting from the financial stability meeting because, in the end of the day, they're all interlinked. But I think that, the point I want to make is the question is minus 7% plausible? Is it not an optimistic forecast? I think that in the Monetary Policy Committee, we outlined very clearly that, there are downside risks to our growth forecast. We need more information on the length of the lockdown, and we leave that to the next MPC meeting. But just to say that I think that one of the most important issues about financial stability or preoccupations of the Financial Stability Committee is, what are you missing? Currently we think that, the banks are resilient. There's the larger financial system. We haven't talked much about money market funds and other parts of the financial system. But I think that, the same goes for the banking system, that our stress test, as Hendrik outlined, assumed a minus 4.8% growth scenario. If we go to something like minus 10%, of which some of you have referred to, obviously we then have to think about the second phase of the crisis and how resilient our banking system is. So I think that these are questions we can't be complacent about. It's important for the Financial Stability Committee not to kind of create panic, but at the same time, the Financial Stability Committee, as the governor says, is the worry committee. We've got to be looking out for what are we missing. It is something obscure in the financial system that we're not picking up, that we think needs attention. And I think that's an important point to make. There's also the question is, are we going to be coming out with more frequent data around non-performing loans, around the drawdowns of the loan guarantee? I think that as far as the drawdowns of the loan guarantee scheme is, a governance committee has been set, and this committee will probably decide how it wants to package information to the banking sector, to the public, and so on. As to the rest, at this stage, we will publish what we can. We have many 1 month data, which 1 month frequency data, which we will continue to publish. Beyond that, I see it hard to publish anything at a greater frequency because of the nature of the statistical processes and so on. Thank you.
Thank you. Emma, I don't know whether this hand of yours is from the previous round or it is a new hand.
It's a new hand, Governor. Thanks for giving me another question. I was having a read this morning of the financial stability reports put out by the Fed and the central banks in Italy and the ECB and so on. And they seemed a little bit more pessimistic, I guess. I mean, the Fed, for instance, said no bank or financial institution was immune from defaulting on their debt or from asset sales or from really quite substantial losses. And I just wonder whether the South African banks aren't facing these same challenges, and if not, what exactly is it that makes them more resilient than their international peers?
Did you say the Italian financial stability review?
Yes, so I looked at a number of the financial stability reviews put out by the Fed, Italy, the Italian Central Bank, the ECB, and what kind of things they were warning of in their financial systems. And for instance, the Fed was the one that said, no bank or financial institution is immune from debt defaults or asset sales, that kind of thing. And I just wonder whether there's something different about the South African banking system that means they don't face a significant challenge.
Okay, good. Thank you very much. So that was the last question. There are one or two that are coming through the YouTube channel. Kayam Kulusi is raising a question about what would we need to see before we lift the capital relief measures. We decided to provide the capital relief because the banks themselves were providing relief to the clients. So they were either rescheduling the debt, providing holidays, debt holiday, repayment holidays to some of their customers. And for that would have meant that they would have had to hold more capital for. So the capital relief was then meant to enable the banks to provide relief to households and firms. And then related to that was a question of whether the banks are geared for a credit-based expansion. Banks are in the business of lending money. They take deposits and they lend the money. And in lending the money, they have got to assess the credit standing of the borrowers, and if the borrowers are of a good standing, they will price the risk accordingly. If the borrowers are risky, again, they would be priced as risky customers. So banks are by nature credit institution, and that is the business that they are in. As the Financial Stability Review did point out, in as far as the credit cycle is concerned, we are not seeing any stresses that the growth in credit is below the long-term trend, so there is scope for it to go back towards a trend. Emma, your question is complex. I have not read the Financial Stability Review of the Bank of Italy. I have read snippets about the ones for the ECB, and I guess the Euro area banks and the South African banks are facing different challenges. And we had always taken a position where our banks had always built buffers. And that is why getting into this COVID crisis, when the banks had to provide relief to firms and households, we were able to allow them to dip into their capital buffers. I am not sure that you could say the same about the banks in the Euro area, and I guess the Bank of Italy and the ECB, when they point out the risks that are built in the banking sector, that there it is based on what they see with respect to that. Rashad, Kuben, or Alex, I don't know if any one of you had read those financial stability reviews and whether there is any comparison that you can draw with South Africa as we close.
Chair Kubenya, I wouldn't mind responding to 3 short issues in conclusion. Let me start off with Emma's point. Emma, let me say both the fact that I do believe that South African banks are more resilient than European banks and more resilient than the average globally. And that's because they've got larger buffers on capital and liquidity. But let me also say that South African banks are not immune to making losses. They are not immune to collapsing. We've had a small banking crisis in 1985 during a macroeconomic period of stress. We had a small banking crisis between 1998 and 2002 as a result of macroeconomic stresses. I think we go into this crisis with a sound banking system, well-regulated, well-capitalized. But I do think that we will face stresses. I do think that there will be banks that come under stress, come under pressure. The longer the crisis, the deeper the crisis is, it will place pressure. And, you know, again, South African banks are not immune from failing. The public must know that and understand that. From a SARB point of view, we will do everything within our power to prevent that, prevent a failure. But we think the system as a whole is stable. Say the second issue on the length of how long we will provide such regulatory relief. We have not given a time frame for how long, precisely because the moment you give a time frame, the banks start responding with behavior changes. So if I say 6 months, in a month or 2, the banks will say, oh, we've got to rebuild buffers. So we have not given a time frame. At the end of this crisis, we will assess how deeply banks have dipped into their buffers, and we will give them a reasonable period to rebuild their buffers. Reasonable must take 2 things into account. 1, the need to rebuild buffers to restore the safety and soundness of the financial system. But 2, if that is too fast, it will provide too strong a headwind to the economy, and the economic recovery itself may be compromised. So we will take that decision towards the latter part of this crisis. We have not given any time frames now. Kiran, are the banks geared for expansion of lending credit? Again, let's assume that XYZ hardware store defaults, they go under. That requires the bank to take an impairment. That reduces the amount of money available for lending to the economy. And that's why you, in general, get pro-cyclical behavior from banks. The regulatory relief measures are designed to minimize that. So they're designed to slow down the pace at which banks reduce lending. It's not quite designed for a credit binge. We don't really want a credit boom. We're not expecting a credit boom. And that's why the SARB has been careful, even on interest rate reductions, not to call these stimulus measures, but to call these relief measures, relief to customers and firms, relief to banks, to be able to continue to operate and to minimize the negative impact of the crisis on their bank balance sheets and therefore their lending. That's it from me, Chair. Thanks.
Thank you very much. Rashad, did you have anything to add?
My reading of, at least in the last couple of days, the Bank of England, the ECB, and the Fed has come out with financial stability reports. And my reading of one of the main concerns of those financial stability reports is that given that we've had a number of Basel reforms, particularly around the banking sector in the last couple of years, you've had this massive growth of the non-banking, or what's referred to the shadow banking sector. And one of the areas that many of these countries are trying to come to grips with is, are there any interconnections, financial interconnections between banks and money market funds and banks and insurance funds? Are there are massive valuations of assets likely to put financial stability at risks? These are the kind of things that I think we have been looking at, but require more data and are working at this. But I think by and large, that's an area that I think going forward we'll follow through on very closely. Thank you, Governor.
Thank you very much. Those were the last questions. Just to say that clearly what this crisis had done was that it had tested many of the stress tests that were done before. And conversations amongst central banks are that we probably might have to do additional stress testing for the financial system in the light of COVID-19. And especially if you were to have a second wave of infections. That is a conversation that is going on amongst the central banking community. And I've got no doubt that we, being part of those conversations, we will also relook at our own stress testing as the crisis unfolds. And just lastly, that Kuben talked about that capital stuff, that there was also a question about whether we would be withdrawing a directive on dividends. We didn't issue a directive on dividends. We issued a guidance on dividends. And so far, we have seen at least 2 institutions that had made an announcement of their own volition to say that they would not be paying dividends. And that just makes sense that in an environment where you have got stresses like we have in terms of this crisis, that banks will take measures to make sure that they also protect their balance sheets in addition to providing relief to households and firms. Let me thank you very much for your participation in this virtual financial stability forum. For those of you who constantly follow us, hopefully we will see you with the July MPC and the July analyst calls. But thank you very much for joining us, and enjoy the rest of the day.